Recently, the Nasdaq has gone to all-time record highs, and the S&P 500 in the United States of America is within striking distance of an all-time record high itself. So this brings into question US equity valuations. Now, I speak to some commentators who say, well, of course the stock market is overvalued. It's a long-in-the-tooth bull market. It's been going for over 9 years now. Other people say, well, wait a second. No, earnings are catching up. So this is not the case at all. This isn't one of the risks to the US market. On the telephone now, to give us some enlightened thought is Victor von Reiche from Citadel. Victor, this is such a pertinent time to be talking about it, because as we get to the situation where Apple is soon to be a $1 trillion company, one would have thought, the Nasdaq going to all-time record highs and the market shrugging off all sorts of negative barriers that are being put in its place. What is the situation? Before we get into the nitty-gritty of the report that you sent me, what do you think?
Good day, Lindsay. I think it's much more nuanced than I think a lot of market commentators would have us believe. I think the reality is we live in a fast-changing world, and I think given what's happened in the macro or backdrop, I think you have to really spend a lot of time to try and understand what is driving US markets and global equity markets for that purpose. And I think the work that we did was to try and understand what the intersection of the macroeconomic impact on interest rates and US equity valuations in this instance is.
You say the reason for apprehension stems from the fact that US equities have been in a very strong bull market since the lows reached in February 2009, as I said earlier on, following the global financial crisis. In fact, subsequent cumulative total returns, including dividends of 350%, are at 18% per annum. Scrutinizing records you go on that date back to 1940, and we can see that this performance now matches the longest sequence of consecutive positive annual returns. So if you're an historian, you can say, well, if we look back retrospectively, then of course we're at the top of the bull market. That seems to me, given the rest of your article, a rather simplistic viewpoint.
I think it's not unreasonable to be cautious. I think given the fact that we've had 9 very strong years of a bull market in the US, and I think there's definitely pockets of overvaluation. And there are a number of reasons to be concerned. I mean, in the article, we talk about the VIX spiking, the volatility index spiking. And you've also sort of had an unprecedented 2017 where you've had record equity returns with very low levels of volatility. And that's clearly not a sort of a sustainable, situation. And I think if you paint the backdrop of 9 consecutive years of very strong positive returns, it does beg the question, when does all of this turn? And I think the conclusion for us anyway is that you have to be very nuanced and pick your companies that can, sustain earnings growth, because macroeconomic, volatility is back. It is impacting equity markets, and the VIX index is testament to that. So I think, again, not unreasonable to be cautious, and I think subsequent returns will be lower, but I think what we've seen in the media specifically is very alarmist talk of, equity markets being overvalued by significant margins, and that we can expect a sort of an imminent significant correction. Yeah. And we don't think that's the case. So we acknowledge the fact that you need to be circumspect, and there are a number of risk factors on the horizon, but we don't think valuation per se is one of those risk factors. A US recession is certainly a possibility as one risk factor. The Fed withdrawing liquidity, there's a very strong argument that we've had very accommodative monetary policy, and that's fed through to lower interest rates. That, again, is not the complete picture. I mean, what we've seen is a structural drop in nominal GDP from the 1980s, and you've had a subsequent earnings or interest rate drop as well. So those two merge each other very closely, despite the extraordinary monetary policy that we've seen being implemented around the world. The reality is that nominal GDP, has been dropping, and therefore interest rates have been dropping as well. And I think a lot of bears would then argue to say, well, it's really just your discount rate that is allowing for elevated market multiples. And that, again, is not completely true. If you disaggregate the hurdle rate that equity investors demand for investing in equities around the world, it really comprises of a risk-free rate, and that's been declining. And then a second component to that is an equity risk premium. That's sort of the premium that you demand over a risk-free investment. And if you add those two numbers together, we've seen a mixed change in the sense that the risk-free rate is low, but the equity risk premium has increased. So investors have been cautious in a sense. And I think that that is the reason why we don't think the discount rate mechanism is what's really been driving markets higher. It's been the record amount of cash that's been returned to shareholders. That is, in the form of dividends and share buybacks. And that's where really what sustained the market. It's not just a drop in the discount rate per se. It's really the cash that has been returned to shareholders over the past 10 years or so. And that's really what's driven markets higher.
And who's to say with the tax reforms that will stop? Because if there's more money, and we can see that the tax reforms are already having an effect on US earnings, what can these companies do? They've been buying back their own shares and returning money to shareholders for so long now. Is there any indication, given the tax reform situation I've just alluded to, that they will change their policy?
Again, I think you have good actors in the sense that companies that have the balance sheets that allow for them to borrow more money, like Apple is a good example, that have been buying shares at valuations that are attractive, have created a lot of shareholder value, and they still have ammunition in the sense that they're still generating a lot of cash flows. Some other companies that are in more cyclical sectors that have indebted their balance sheet by borrowing money to buy back shares, I think those companies are under pressure, and that potentially is a risk event where if interest rates continue to rise on the back of high inflation and higher real growth, then I think some of those companies could be under pressure because they've really been busy with financial engineering, and that's not sustainable. And again, it comes back to my earlier point of I think investors need to clearly distinguish between the high-quality companies that can sustain earnings growth that can weather macroeconomic volatility versus those companies that can't do that.
You talk about pockets of overvalued stocks rather. And is the United States situation almost a mirror image, but in bigger form, to the South African situation where Naspers dominates the all-share top 40 index and the tech stocks in the United States dominate most the S&P 500, for example? And I'm not talking about physically, I'm talking about almost psychologically, because the other day when 10 cents result came out, a lot of the sectors of the JSE was down in anticipation of the 10 cent results not being good. As soon as they came out and they were fine, the whole market went up, which is irrational to me. Is it rational for me to look at a headline saying trade wars hang over the market, but it's all been ameliorated by, for example, the performance of tech stocks? So in other words, as long as there's tech stocks are doing well, we don't have to worry about other things. It seems to me that there's a great similarity between the JSE and the US markets.
There is some similarity. There's no doubt about that. I think from our perspective, I think most investors would want a wider breadth of, strong stock returns in an index. That just feels better from a risk perspective, that that if you look at a specific index globally, that it's not only the tech stocks, that a lot of sectors are contributing to pushing markets higher, that you have to have that sort of breadth of, momentum across different sectors and not just technology. I think, again, that talks to the structural change that we've seen in markets. So it's very, if you look at certain valuation metrics like the CAPE ratio, which basically cyclically adjust earnings, what you're missing is that equity markets can and do change over time. The dominant businesses, obviously, by virtue of their big market caps, come to dominate indices. And certain of the top tech stocks that you mentioned, like Tencent, as they become bigger, they almost seem to grow faster. So I think that is different from maybe 10 or 15 years ago, where you had big oil companies, big financial companies, big industrial conglomerates really making up a significant chunk of your indices. And today it is tech. It's a structural change. We don't think it's just something that you'll see in the US or South Africa. We think it's really a global trend, but it also brings in more competition. So to answer your question, I think it is concerning that you have one or two stocks driving an index higher, but that is the reality at the moment, and it's just something I think investors will have to get used to.
Yeah, my point, I think, when it comes to liquidity is that the liquidity means that the withdrawal of liquidity from the US Federal Reserve will mean that there's a slowdown in the bull market, maybe a flat liner, because obviously the froth of the last few years has been, to a certain extent, because of that liquidity. Primary dealers getting given cash almost every day to punt the market. You conclude by saying this framework does not suggest extreme under or overvaluation at current market levels. A number of risks, though, remain as highlighted, which could impact markets. We don't think valuation risk is top of that list at the moment. So valuation risk is sort of in the middle of your list of factors, but you do think there are things out there which could cause a shock and bring the market a little bit back down to earth.
Exactly. I mean, we've spoken about some of the risk factors. The one is liquidity that you mentioned. I think when the Fed is withdrawing liquidity from the market, that is undoubtedly a headwind. That's one risk factor. The other is obviously geopolitical risks, trade wars that impacts global growth. The third factor is U.S. recession. Obviously, we are quite deep into this economic recovery, which has been very long and quite shallow if you compare it to previous economic recoveries in the U.S. And we look at a number of indicators, leading indicators, U.S. unemployment. We look at, for instance, high yield debt, where the yields are spiking or spreads are widening, I should say. We look at a number of other factors, and at the moment, it doesn't seem to point to a U.S. recession. But obviously, that is something that can't be, we're talking probably an 18 to 24 month time horizon that the U.S. maybe starts to slow down. That's clearly a big risk factor for U.S. equity markets. And I think obviously inflation, that's a one factor worth mentioning. If the U.S. economy comes back and we see strong real growth, which we've seen, and inflation remains moderate, that's a very powerful cocktail for equity markets. But if bond yields move high on the back of higher U.S. inflation, then I think all bets are off, because then that impacts your discount rate and it impacts companies' profitability. So what we don't want is moderate real growth and inflation really moving much higher. I think that would clearly feed through to companies' profitability. It would impact the discount rate, and then we could see probably at least a 20% drop in markets. If real growth stays healthy, I think then we are comfortable with U.S. equity valuations where they are at the moment.
It's going to be a fascinating bull-bear tussle, or as one person used to say to me years ago, there is a bull-bear partitioning line, my friend, he used to say. Okay, Victor, great analysis. Thank you very much for your time this evening. That's Victor von Reiche from Citadel.